Good afternoon and welcome everyone to today's US market update and first quarter earnings review. Great to see so many on today's webcast. My name is Kelly May, Associate Portfolio Manager, and with me today are Fortrend CEO Joe Forster, along with Portfolio Managers Stephen Lyle, Chris Wallerman, and Andrew Corcoran. We welcome question and answers throughout the presentation. Please feel free to click on the Q&A tab at the bottom of your screen, and we will do our best to answer the questions as best as we can. With that, I'll now turn the presentation over to Joe.
Thank you, Kelly. The market continues to run largely on the back of this quantitative easing, but also on the COVID recovery. S&P 500 up 5.5% this month, while earnings estimates for next year were up only about 1%, pushing the forward-looking price-earnings ratio just above 20. So we're paying for 20 years worth of earnings adjusted for growth. The 10-year Treasury yield continues to go up from 1.4% to 1.67, which is reflecting increased expectations of a recovery, but it's not implying any inflation. The foreign countries that issue U.S. debt, emerging markets, or European countries that are also linked in many ways to the U.S. 10-year Treasury, have seen yields rising, in fact, doubling from about 50 basis points to about 100 basis points on those foreign issue debt. So we are seeing increased flow through on the U.S. 10-year Treasury into foreign markets. The G7, for those of you who aren't aware, is made up in Europe of the UK, Germany, France, and Italy, and that's 4 of the 7. And then there's the US and Canada. So, and then add to that Japan. So that's the G7. Note that there are several countries that are not in that group. China, for example. We bought Boeing mid-month. Bought there is spelled the way we would fill out a trade ticket, not normal spelling. Viacom was up on a lot of purchase buying pressure, and then fell down because of a hedge fund company called, and many people pronounce this different ways, but let's just say Archegos, was caught in a big margin squeeze. So the big news this month was the rapid rise in the number of stocks like Viacom and Discovery and a few others, and then the margin selling and the systemic risks that's exposed in the marketplace, which we had hoped would have been resolved 10 years ago by Dodd-Frank, the financial regulations bill passed by Barney Frank and Barney Frank. So Dodd-Frank did not solve this systemic risk. So expect the SEC. Well, the way this worked is that this family office was not a fund. And because it was not a fund, it was not required to disclose its holdings in a public statement. So the first thing they did is they hid under the radar by being a, quote, family office. And then the second thing they did, instead of buying these stocks, they bought swaps into the stocks that were manufactured by Wall Street firms. So there's Wall Street manufacturing swaps again for anything anyone wants to buy. So that was able to allow this Archegos hedge fund to buy these stocks with 8 times leverage. And then the swaps were, of course, owned by Wall Street firms, and there were margin calls, and the thing came tumbling down. We'll go into more detail on that, but there has to be transparency on these swaps to expect the SEC and Congress to come down hard with new laws. Biggest movers in the market, we see there are some companies that are not meaningful here very much, like Bombardier. We leave that in there because this company has a lot of business here in Australia. They make the trams that many of us ride on. But they were also making planes, and they got into a battle with Boeing when Trump first came into office over subsidies from the Canadian government. Bombardier is based in Canada, and they are really thinly, they're a struggling company, and that they're still in the portfolio, but because Boeing put the boot on their neck and trying to put their small aircraft out of business, they're in trouble. Now, Volkswagen is the big story here this month. And we all know Tesla's rolling out electronic vehicles. Volkswagen will go into more detail on this, but up 50% this month as they tripled their EV sales and made agreements with QuantumScape, the big, who has some very interesting patents and technology on new battery technology. But Volkswagen making a big commitment to the EV space, and just the explosion in the belief that electronic vehicles are the future and combustion engines are going to go be diminished significantly. So what we've seen there is Volkswagen announcing, and Volkswagen is now the biggest auto manufacturer in the world. They surpassed Toyota, so they're the biggest company in the world. Now, another thing we see here, U.S. Steel, Cleveland-Cliffs, which exited its Australian iron ore business, but still a steel company. Nucor, these three steel companies are seeing a big rebound. When Trump came into office, he decided to try to protect these steel companies, and it did nothing for the stock prices. And now suddenly we're getting a big rebound, not only in U.S. Steel and Nucor, but as you go down the list here, you see some other cyclical stocks in there like Alcoa. Owens, Illinois is bouncing off the bottom, which is partly refinancing debt story. They're very low margins compared to Ball. They make glass containers, et cetera. Also, I want to point out Applied Materials. We've had a big interest in semiconductors. This is the hottest spot in the market this month with the big battle over Taiwan and who's going to control semiconductors, and Intel announcing some big plants, but we'll go into that in more detail. On the downside, one of our investments, Viacom CBS, what happened is that they were owned by this hedge fund, Archegos, and they went up dramatically and lost some of that value. They're back down to where they were 2 months ago. And that's the same story with Baidu, caught up in the margin selling. I bought some more Viacom for my personal account just last week. BlackBerry will ignore them, Baker Hughes, Spotify. Interestingly, even though you're seeing big resource companies go up, I can't explain this because I don't follow them closely, but BHP and Rio are down about 10%, and I'm not sure why. You should ask your Australian broker about that. I do put them in the model portfolio, the model here, so that I can keep an eye on how things are changing, being so significant in the world, but they're not stocks that we're following, other than to have them in the report and to see that they're moving contrary to all the other resource companies in the market. Those are the biggest movers. Anyone want to comment on any of those stocks?
Well, I think it might be worth highlighting Kansas City Southern, which is a medium-sized railroad in, Kansas City. It's being acquired by Canadian Pacific Railway for cash and stock. The total deal value is about $290 per share.
Mm-hmm. Well, Steve, that makes me want to stand on one leg. I'd like to show everyone that I can actually stand on one leg now. It's amazing, having had a hip replacement just 2 weeks ago. Not moving, Kelly. How do we go to the next page? Okay, so this is showing the earnings going back and forth as it does in the relative value model graph, and the prices going up and down. And on the earnings, what you can see there is that there are big increases for metals and oils. Now, metal and oil is coming off a bottom, and oil is coming off a bottom, but the big increases in earnings estimates this month are coming from the deep cyclical end of the market. Now, what that should do is cause increased price pressures for companies like, let's say, Coca-Cola, or more importantly, a bottling company like Amatil, which is being taken over by the UK company, but where they're buying what I call aluminum, what you call aluminium, where they're going to have increased cost pressures for construction, for automobiles, et cetera. It's going to push all the way through the economy. And so the big increases in raw material prices for metals and oil will push through and increase costs for a lot of different companies. And so you should expect during this earnings season, some companies warning that they're seeing increased costs. Now, there's going to be spot markets and there are going to be long-term contract markets, but that spot market will, and evidently from these earnings estimates, increases will push through both in spot and long-term contract markets. This is the relative value model, which allows us to visualize how on the vertical scale, we're seeing a price divided by sales. And you can see the FANGs are trading at almost 8 times sales. And along the horizontal axis, you have the return on our forecasted earnings for sales and what the margins are. And you can see in the bottom left, auto has a relatively low return on sales, low margins. And they also have a low price earnings ratio, because when you normalize price and earnings by sales, the slope is the price earnings ratio, and the line through the middle is the price earnings ratio for the market. So you can see pharmaceuticals with high margins and a low price earnings ratio. You can see biotechnology, interestingly, nowadays with high margins and a low price earnings ratio, whereas biotech used to be 10 or 15 years ago, low margins and a very high price earnings ratio because they weren't making money yet. There was the prospect of them making money in the future. They were going to have a big increase in earnings, so they were trading at a high price to current earnings ratio, where now they're trading as a more mature industry, particularly Amgen being the company that is the most advanced in terms of developing a pipeline of products and getting to market without having that patent cliff at the tail end. So biotech, interestingly, in 15 years ago, would have been in the bottom with a higher, it would have been at a price to sales, well, would have been down to the left with a high PE ratio. So this is how we view and monitor the market. Kelly, do we have a question? What are the bats?
Where are they?
Where are they? Well, Andrew, why don't you answer that question while I answer that?
Yeah. So I think we saw Baidu, oh, the bat's actually not on this chart, actually. But I can tell you that the PEs for Alibaba, Baidu, and Tencent range between sort of 18 and 35 times, 35 times being Tencent's forward multiple. And that's pretty consistent with the growth that they're projected to have, which is in the mid-20s range, top line growth. Baidu has had a monstrous PE multiple expansion in the last 6 months, and that's also on the back of this massive surge in EV type multiples being applied to stocks. And of course, Baidu outlined their EV strategy based on their Apollo software program a few months back. That's had a big correction. That was, as Joe mentioned just previously, part of the Archegos short sell, sorry, the margin call sell. And Alibaba, Alibaba's generating revenue growth of about 35% year on year. At scale, they're projected to have about $108 billion in revenue, US dollars, this year, versus about $74 billion last year. And the growth there, obviously, with the regulatory scrutiny going on in China right now for the biggest dominant tech companies, that seems to be overshadowing what is very strong fundamentals of each of those 3 companies. And we've mentioned previously that we're looking for an opportunity to get back into Tencent, which is the world's largest gaming company by sales. So I think on that basis, yeah, maybe it's Joe's it scattered in.
It's part of that banks.
Yeah, but is the bats in that scattered
It's
cluster?
the FANGs in the top left, so it is included.
Oh, it's in the FANGs up there.
Yeah, it is part of the FANGs.
Yeah.
Thank you for asking. Banks, I want to talk a little bit about structure here. In Australia, we have 4 pillars, and the 4 pillar banks are all very similar. The tax system here is that when somebody borrows money to buy a home, the interest payments are not deductible. But when a bank makes a profit, and Australian banks have the biggest profit margins in the world, and they pay a dividend to people like us, we're going to get that tax free because they make their money here and get a franking credit. So this is a transfer of wealth from people who are trying to buy and own homes to retired people in helping to maintain their lifestyle into retirement. The result of this tax system results in 4 pillars that are fairly generic with very high margins. In the United States, the tax system is the opposite. When somebody borrows money to invest in a home, the interest payments are deductible. And then when shareholders receive dividends, they're taxable. So it's the opposite effect in the United States and in Australia. And as a result of that, the US has a very diversified financial services industry. So it's not possible to compare a 4-pillar to a US bank. And the US banks are broken down into several groupings. One is investment banks. Earnings estimates are all ticking upwards except for Deutsche Bank and the Australian banks. Earnings estimates are ticking up because interest rates are ticking up, increasing the interest rate spread, while investment banks continue to benefit from quantitative easing, which is where the Federal Reserve Board buys bonds. Chris, why don't you explain how quantitative easing works at the risk of, do it briefly because we've done this before, but it's a good reminder at this point.
Sure. So it's one of the more recently adopted policy tools of central banks around the world. And after the financial crisis, it's this sort of emergency policy tool has almost become the norm, but it's intended to prime the pump by supplying liquidity, relieving banks and other financial institutions of illiquid assets. A lot of them were toxic and with the passage of time have matured and not defaulted, and actually the Federal Reserve has made money out of these investments by effectively being the marginal buyer or the marginal provider of liquidity. And then it's intended that by exchanging illiquid or toxic assets for a credit to the reserve account, which banks retain at the central bank, that will stimulate lending and help the economy recover. So that's the intended measure, and we've seen following through the coronavirus pandemic, obviously a lot of fiscal stimulus, but an extraordinary amount of central bank effort as well to not only keep rates at or close to zero, but also expand the balance sheet.
By the way, next month, we're going to start doing these presentations back in the office again. And there's a very remote possibility that the next seminar could be catered by Voudemont. But it's a very remote possibility. I wanted to let you know that. But I hope we'll see you in here. Australian taxes, quantitative easing. The US is the opposite, more competitive, more innovative, and a more diverse financial services industry where we have investment banks like Morgan Stanley and Goldman Sachs. Credit Suisse bought First Boston, and UBS bought Payne Weber, and Payne Weber entered the US investment banking world by buying Payne Weber and somebody else. But those big Swiss banks have exposure in the US investment banking space too. Money center banks, Wells Fargo, JP Morgan, Bank of America, and Citigroup are in particular benefiting from the net interest rate spreads improving with the 10-year treasury going up. Then we have payment systems like MasterCard, Visa, PayPal, and Square, and it's just nothing like that in the Australian market. These are global service companies. Custody and asset servicing, State Street and Bank of New York. So that's where they'll hold assets for a fund, and then servicing is where they'll process the corporate actions and dividends and reporting for the big fund managers. So custody and asset servicing. US banks are not a substitute for Australian banks. They diversify away from this concentrated risk. So don't think of our investment in Goldman Sachs as being an alternative to an Australian bank. Goldman Sachs, who's going to talk about Goldman Sachs? Chris, it's up to you.
Thank you.
Very good.
So I think this Archegos situation really serves as just another demonstration of something that we've highlighted at Goldman Sachs through the duration of our about 2.5 year investment, is that they have a fantastic track record of capitalizing on and profiting from a crisis. So we saw that through the pandemic, where quarter after quarter they had standout results in their Wall Street style divisions, fixed income, currency, commodity and equity trading, the capital markets and investment banking divisions, as companies needed to tap capital markets or restructure, and investors transacted a lot in a volatile asset price environment. And a lot of investors discounted that that strength as being a one-off. And it's been curious to us that with that tailwind receding, as we return to some normalcy and anticipate a post-COVID recovery, that Goldman Sachs stock price appears to have been driven higher more so by the steepening yield curve, which traditionally you would associate with rising net interest margins and interest income for those more Main Street style banks. However, Goldman Sachs has highlighted their ambitions to become more of a consumer-facing, consumer-oriented lending institution. So whilst they've benefited from having minimal exposure to credit through the pandemic, it's probably not a bad time now to be investing to diversify their business model. And if we contrast the news around Archegos the last month, how that's impacted the likes of Credit Suisse and some other banks who were prime brokers, Goldman Sachs and Morgan Stanley were very decisive and bailed out, cut their risk first. And that contrasts mostly with Credit Suisse, who have will be taking something like a $4.7 billion US dollar equivalent hit due to their involvement with Archegos, as well as Greensill Capital. So I guess those two experiences demonstrate the smarts of the team at Goldman Sachs. Back to you, Joe.
Thanks, Chris. Consumer products, there were big increases in estimates last year, and there have been no changes in the current quarter, or no warnings coming into the season. Now that's a little bit surprising because sales of shampoo, the stock prices have ran up last month. Shampoo, deodorant, razor blade volumes are all down because people are at home and they're not bothering to shave, or can't imagine, not grooming. So fewer people are getting dressed up and going out and using these products. We don't own any consumer products, and we're not going to buy any of this cycle. Now, there's a lot of similarity between consumer products and the food sector. Of course, the food sector benefited tremendously from the lockdowns because people were staying at home and cooking at home. And they were, as we coined the phrase, snack and click. So they would eat their cheese and crackers from Kraft, and then click on Google and Facebook, and there was, of course, all the beneficiaries of the pandemic, which were allowing remote work. But the clicks and snacks companies are capped out. Now, there is another set of companies that service venues or the away from home market. Budweiser is based in Europe, and what are the brands they own here in Australia? They own Foster's and Cascade and a number of brands here in Australia. But Budweiser, Stella, they don't own Heineken. They're the biggest beer maker in the world. I think they own Corona, and I'm going to get some of these brands mixed up, but they are gigantic. But of course, they're going to sell things at football games or at baseball games or at concerts or events. And so the Coca-Cola, and they're also selling at restaurants, of course. So Coca-Cola gets about half of their business from the home sales and about half of their business away from home and events. And what we're seeing now is this pending recovery in event sales and a recovery in the stock price. So it's doing quite well. We're very pleased with our investment in Coca-Cola. Budweiser is something we would watch closely. Coca-Cola, Steve, you talk about our commitment to Coke?
Sure. They'll report in about 2 weeks, and we expect earnings per share of 50 cents with a very narrow standard deviation or variance of the estimates among analysts who cover it. They earned 44 cents last year, and so I think that this is reflective of the very good management at Coca-Cola in a difficult year, with over half their sales from events and restaurants really coming to a standstill. They have managed their balance sheet very well. They've trimmed assets, so they're less asset heavy, and they're focused on profitability. We would expect in this call, in the earnings announcement, probably some guidance around increased costs. We're seeing that purchasing managers and supply chains are seeing costs increase in the last quarter. That could be indicative of coming inflation for consumer prices. We'll see, but it's being pushed through the system right now. And we would also expect a potential buyback announcement. They've got plenty of free cash flow and about $10 billion in cash currently. Entertainment. I'll give it back to Joe.
Of course, the entertainment industry is going through a lot of disruption, and it's not just shifting to streaming, it's also 5G. And Dish, which makes Dish satellites, maybe they should change their name, are building out a 5G network in America to offset their declining business and pay TV subscriptions. So building out 5G networks is becoming very popular now, and it's becoming a little bit of a race. T-Mobile is heading that race, but Dish estimates were up because they're building their 5G network out. News Corp, which of course run by Rupert Murdoch, owns the Wall Street Journal, my favorite paper to read, the Post and the Herald Sun, which is an absolute horrible paper to read. I think of it as law for the masses. They own Dow Jones. Sorry, am I insulting readers of the Sun? I hope that I spelled Herald Sun wrong. I think I did. Maybe I should maybe I should read it. Okay. Anyway, they are pivoting from print to digital, and they're doing an excellent job at pivoting from print to digital. The earnings estimates are up as it's handling this transition better than companies like Gannett or the New York Times, et cetera, et cetera. Very well managed. Comcast, which bought NBC, you know, the big broadcaster, and owns Universal Studios, had big news this month with the opening of Godzilla versus King Kong, and it's opened up in theaters. I wanted to play another great streaming movie for you called Bambi versus Godzilla, which you may or may not have seen, but it'll be a little comic relief for you for 1 minute. Can you bring it up? Everyone see that? Can you see that? We might have to email the Bambi versus Godzilla comical 1 minute to you. Does anyone send me a message to see if you could see that? You need to share that window, right? Can't see it. Okay. Bambi versus Godzilla is funny. You'll have to look at it later. In entertainment, we have next time. Click through, right? Because it's on the same screen. Video is advancing very well as we shift to streaming, and Viacom is a major beneficiary of that as they roll out their streaming services. We will share the link. Thanks, Jordan. Next, Kelly. Eyeballs are gravitating towards, I did this deliberately, gaming and gambling, or gambling. Companies like Electronic Arts and companies like the big gaming companies, Sands, et cetera, they're doing the same thing for different age groups. One you can lose money at, one you can spend money at. But gaming and, as I call it, gambling or gambling is really very much the same psychologically addictive stuff. And it's horrifying to me with a 17-year-old to see how it's, I think, destroying his life. So big aversion to that. CBS Viacom. Now, we're going to talk about this. See,
They'll report on May 7th. It's been a wild month for Viacom stock. Maybe we'll go into Archegos. Bill Wang at Archegos, who started his career at the Asian funds that Julian Robertson started, the Tiger funds. He was a successful fund manager there until he got in trouble with the SEC. But Archegos is essentially a family office, and he was managing his own money, which is estimated to have been worth between 10 and $20 billion in net capital. But with that net capital, he was able to have significant leverage through the use of total return swaps, which essentially function in this way. Citigroup will issue a swap to Bill Wang at Archegos, and Bill Wang will pay a regular fee for that, and it will be backed by a basket of equities total return. And in this instance, that basket was approximately 10 companies, so it was a very, very concentrated portfolio. And where was I going with that?
Well, we were talking about the swaps work and how
Right.
get all the
Very, very concentrated portfolio, to the extent that Bill Wang's economic exposure to Viacom was approximately 25% of the overall company. He had exposure to 25% of the outstanding shares, which when Viacom announced their $2 billion equity issue, the margin call, excuse me, this sort of here. When they issued $2 billion in equity or made that announcement, the shares promptly fell, which triggered a margin call, which then exacerbated selling. And it was a negative feedback loop. And we saw Viacom's share price halve in value. Now, with that said, Viacom's still about 450% above where it was trading this time last year. So it's been an okay performer for us in the last 12 months, in spite of February's, or rather March's, very bad month for the stock price. At 10 times earnings, it looks like pretty good value to us. Do you want to add to that, Archegos?
No. I think that there's been artificial selling pressure as a result of some hidden swap contracts, and that I bought some stock just recently. I bought more. So why don't you continue with my one of the companies that I think is a real ethical dilemma. For those of you who didn't want to buy Exxon, I think Electronic Arts is a much more ethical dilemma type stock, but we're getting close to potentially selling that.
Yes, it's been a good performer for us, up about 40% from our acquisition in July 2019. They will report on May 10th. They've announced $3.3 billion in acquisitions, a couple of mobile gaming companies, one called Blue Mobile, and one other smaller firm. They've also announced $2.6 billion in share buybacks over the next 2 years, and they've got plenty of free cash flow to cover that. Their free cash flow is approximately $1.9 billion annually, and they have about $6 billion in cash on the balance sheet. They've warned about increased costs due to work from home, embedded costs with getting people set up with their workstations in home offices during COVID, and we'll probably hear more about that in this quarter as well, we expect, because most businesses in America still have not returned to the office. As I said, we paid 101 for it in July 2019, and it's up 40%. I might hand it back to Joe for pharmaceuticals.
But for those of you who haven't heard me say this before, I grew up in a place in a suburb of San Francisco, which was a brand new city. And we used to get on our dirt bikes, our motorcycles, and we would ride across the lagoon to now to do jumps and ride our motorbikes around to now what is Electronic Arts headquarters. So the irony is that we used to ride our dirt bikes around and go outdoors and probably do some dangerous things. And now the world has been taken over by video games, and that's how kids spend their time. Pharmaceuticals have very low price earnings ratios in general and relatively high yields. And this is because these companies have big drugs on patent. They spend money on R&D, but these drugs are going to come off a patent and then they'll expire, and there's no guarantee that they'll be able to replace the drugs coming off the patent. And Upjohn is the case in point there. So you tend to have low price earnings ratios because there isn't the prospect of earnings continuing indefinitely, and you have high yields because they have big cash flows. But patent expiration horizons are causing this. Viatris, our investment should be the opposite. It should be a very high PE, and we don't understand why the market isn't recognizing the value that we see there. But before I go on, there are distributors or wholesale pharmacies. Now, about 20 years ago, this family, the Sackler family, decided to create a derivative of opium, which is this OxyContin. And they used McKinsey to get a consulting thing. They'd sent it out to doctors. They pushed this drug on people as non-addictive, and there became an opiate crisis. The doctors would prescribe it. People, then they would pull it off. Addicted people would then go to heroin and overdose maybe on fentanyl, which is coming out of China, or on heroin. So there's been this terrible, terrible epidemic in the US. And now there are lawsuits against the pharmaceutical, not the pharmaceutical, excuse me, the pharmacies, which are Cardinal, McKesson, and AmerisourceBergen. And there's a trial set for May, and these stocks were all up 15% this month on the prospect that there could be a settle in this opiate case before the case goes through. Our stocks all up 15% this month with no changes in earnings estimates. So this is a case, this situation where an ethical dilemma of selling drugs causing a major problem could be settled, allowing these stocks to go back up. I took a lot of opiates recently, and they're bad on the brain, but I'll explain more about that in a minute. Who's going to talk about Viatris?
Yeah, I'll talk about the healthcare stocks.
So as a refresher, Viatris represents the merged Mylan and Upjohn, which was a division of Pfizer, a new merged entity. I think it completed that merger in November or December last year. So I think this will be the second quarterly results as a newly merged entity. Focus will be less on the per share earnings and more on the progress of the various aspects of that merger. There's significant cost synergy opportunity there, and management have always guided to a commitment to paying out a good portion of free cash flow as dividends, which we think will be attractive in a low rate environment to a certain class of investors. So that will be our focus. Viatris is a portfolio of about 20 off-patent generic drugs. Some of the better known are the likes of Lipitor and Xanax and even Viagra. I think Also, that Viatris is a little bit similar to Viacom CDS. It's a stock that has really languished. It trades at a price that was sort of suggested going out of business, which we don't believe is the case, obviously. Less than 4 times forecast earnings, about 1 times forecast sales. And also, like Viacom CBS, the catalyst is a merger, a combination, pooling a portfolio of good products, drugs in this case, or entertainment content in the other case, and now executing on the various aspects of that merger and proving to investors that management can deliver. And that will be the catalyst for significant revaluation in the stock.
Chris, why don't you just mention that? Let me just know, one of the major competitors to Viatris are the knockoffs sold online that are made in factories in India and China. So they do have major competitive competition from unregulated companies that make this stuff in labs and sell it online around the world. And you don't need to go to the dark net to buy that stuff, but it does create pricing pressure for generic companies.
Amgen, we had a profitable short-term investment in Amgen earlier in the year. It was a stock that we identified initially because they appeared to be overlooked by investors, very much focused on pharmaceutical companies with the most promising COVID vaccines or treatments. Meanwhile, Amgen being in some ways the original biotech company founded 40 years ago, has expanded, developed a really good, diverse portfolio, largely immunized from any blockbuster patent risks, and trading at the right price. So we had the opportunity to generate a relatively short-term profit there, and the stock receded, offering another opportunity to buy at about 12.5 times earnings, and the stock has performed well again since that second investment. It's about 13.7 times earnings now, and the dividend yield is just under 3%. Medtronic reports out of cycle. So their most recent report was in February. And one of the notable highlights in that result was that the strongest sales were in their consumables division, which reflects an anticipated recovery. So hospitals, in anticipation of the resumption of elective surgeries, are stocking up on the consumables that they use. And to further illustrate that trend, Illumina, which is a genomic sequencing company, reported results last night, and they demonstrated exactly the same thing. So their revenue beat was driven by the sale of consumables. So hospitals are really gearing up, beg your pardon, for the resumption of elective surgeries in this case.
One of the byproducts of our career is that when I go into a supermarket, I'm comparing the shelf space for Coke and Pepsi, or if I'm going into a hospital, I'm looking at the supply chain and the products and the comparative pricing. And so going in to get a hip replacement, as I did 2 weeks ago, yet on Monday, is an opportunity to look at who makes the devices, how the hospitals work, how they service the patient, and et cetera. So it was a good consumer tour of how this business model works. And I'd say just from a personal perspective, the drugs were horrible. The effect on my brain for 3 or 4 days, I got off them and suffered the pain, but the opiates, you can't think on, bad stuff. I hated the drugs. So anyway, just part of a byproduct of what we do is we are constantly walking through a supermarket or looking at, how does this suit compare to another suit on price and volume? So it is a nice byproduct of the job to spend your free time watching the world and business. Who's going to talk about autos?
I think,
Well, I am. Okay. Look, Volkswagen took over the biggest manufacturer in the world from Toyota, and EV sales is the big deal. They own Volvo, they own Bentley, majority owner in Porsche. They have a bunch of other brands, and they're making a big push into electronic vehicles. So look out, Tesla. We also have Andrew knows a lot about this end of the market. I might let Andrew. Andrew, do you want to continue on this here? Is that all right?
I'll just add, I'm not sure what you've got behind this, but I'll just add there's this arms race going on in the electric vehicle market at the moment, which on 2019 numbers pegged the industry at about $160 billion. And the projections are by 2027, the industry will grow to over 800 billion, and not long after that will eclipse the 1 trillion mark. So that puts it at about a greater than 4 times growth rate over that period, about a 22% compound annual growth rate if you want to think of it in percentage terms. Tesla has said that their longer term or medium to longer term compound annual growth rate will be near 50%. So they've definitely got the jump. They've got the early advantage, the first mover advantage. Interestingly, they just reported their Q1 production and deliveries, and we've touched on in prior seminars about the chip shortages going on in the semiconductor space, and that's having an impact on the auto manufacturers like GM and Ford slashing their production targets because of that chip shortage. Tesla have not come forward, and in fact, with any financial or material impact, other than to say their Fremont plant shut down for a few days, but that was for maintenance, they claimed, with some comment around shortages, but nothing quantitative. But just to say that they produced their best ever quarterly production and deliveries, having delivered just over 184,000 in the quarter, Tesla. So I think the projection going forward is there is definitely a massive profit pool, which is garnering a lot of interest, which is why Volkswagen are getting in, which is why all the other automakers are getting in. But I think, Tesla, we got asked this time last year what's going on with the stock, and it's up over 600% from that point. And I think we're at the very we're entering the golden age of this new market. And I think we all have an idea that there's this green tidal wave coming with a replacement of combustion engines into greener, more sustainable technologies.
Worth noting that the state of California has enacted a law that will end the sales of combustion vehicles by 2035.
Second-hand or new?
New. So the used car sales can continue by 2035. No combustion cars.
So you buy them in Nevada and bring them across the border.
Yeah, there's going to be a whole lot of gaming.
Just this final point, so Volkswagen is going to deal with QuantumScape. QuantumScape is, as Joe mentioned earlier, a battery technology, an EV battery technology company. And what they've got is an anode-less technology, which is a lithium metal battery technology versus lithium ion. And the benefit with lithium metal is you get up to about 80% further traveling distance versus the lithium ion battery technology that's currently in play. So QuantumScape has come about, and it's become a headline name since about November when they went public through a SPAC. And so the stock prices had a monstrous run up. It's come back off with a lot of skepticism around their technology, but with a partner like Volkswagen and the scale of Volkswagen, this is a potential disruptive technology. So keep an eye on QuantumScape. The ticker is QS, and I think it's about a $20 billion market cap currently.
I was asking you about Tesla, Andrew.
Got a question?
Think of you.
Have we missed the boat on Tesla as investors? I'd argue no. If we just go back to how big is this addressable market, putting valuation aside for the time being, the valuation, as I said, we're going to probably get toward that $1 trillion market in the next 6-7 years as an overall industry. And you look at Tesla's sales growing from about 35 billion to about 75 and toward 100 in the next 2 years. So I think the thing to look at is obviously the profitability, and where Tesla are trying to drive cost reductions. This isn't the battery technology. So I think they're built out in China with their gigafab, the broadening of regulatory approvals across the globe. I think it's not too late, but you could argue at $700 a share, is it too expensive? At about 10.5 times sales, I'd argue no, not for the growth that you're going to get, and not for their first mover advantage.
Andrew, I think we need to spend a lot more time looking at the raw materials that go into batteries and whether there's going to be inflationary pressures. If this thing's accelerating, certainly all the marble and some other raw material providers must be good opportunities. Okay. Let's have a look at that. Okay?
Sure. I think the next slide is Alphabet. Slide down. Oh. Okay. I'll hand it over to Steve.
Alphabet will report on the 28th. We expect $15.59 with a fairly wide standard deviation of $1.71. They had a major Supreme Court victory yesterday in a suit that Oracle had taken against Alphabet some time ago. In 2005, when Google at the time developed the Android operating system, they used the Oracle Java software as an integral part of the Android operating system, and they still do, and they don't pay for that. And Alphabet argued that it's covered under fair use, because Oracle normally gives Java away for free. And Oracle had recently won in a lower court decision in this case, and they were seeking damages of $9 billion plus ongoing royalties, which could have been very expensive for Alphabet in the long run. And the Supreme Court reversed that decision yesterday, thus saving Alphabet $9 billion immediately and an ongoing royalty stream. And that sort of settles this dispute forever. At 23 times earnings, we still think it's pretty good value, particularly if you carve out their cash position, which is about 150 billion. It's trading sub 20 times earnings, and they continue to have great growth, 25% projected sales growth. Computers, I'll leave it. I'll give it back to Jeff.
There's been a big rotation into hardware companies on macro calls from strategists, particularly Bank of New York, up about 12%. Network appliances on a run. Their guidance was neutral, but they're moving up, and we like them. Accenture, the consulting firm, they announced great earnings on March 18th, so their earnings estimates were up. And that bodes well for Capgemini, the Paris-based consulting firm. Each of these spun out from big accounting firms. Capgemini's new ambitions for 7 to 9% constant currency growth for the next couple of years is very encouraging. They're focusing on the cloud and security products, and so that's to be expected, really. But other consulting firms like IBM and DXC Technologies are struggling, while Capgemini and Accenture established more leadership position. Semiconductors is the hottest game in town at the moment, with lines being drawn between China and the US and who's going to own Taiwan. US is diversifying away from their Taiwanese exposure rather than defending Taiwan. I thought they were probably doing both. Intel is spending $20 billion for new foundries in the US, which is a good sign. That's going to go into Applied Materials, who will push that down into subcontractors for different tools that go into those plants. So building a fab plant, you could think of it like building a high-rise building. You're going to have a main contractor, and then you're going to have someone who puts in the lights and the elevators and the windows and et cetera. Applied Materials is a similar thing for building fab plants. They're going to have a lot of different tool companies that they bring in to building that fab plant for Intel. Applied Materials up 20% this month. Micron Technology makes the DRAM, that's the DRAM, the dynamic random access, and the flash memory stuff. Their estimates were up 20%, and they look like they're doing well. They reported reporting earnings on the 31st of March, after reporting earnings on the 31st of March. Qualcomm is in the sweet spot. So with the 5G rolling out now, they're report on the 28th. There are about 800 live 4G networks in the world, and that includes Telstra, for example, who claims, I think, exaggerates their 5G exposure dramatically with their boards. But about half of these companies have actually made investments now into 5G upgrades. But I point out this Telstra thing because they say, oh, we're 5G enabled, which is just garbage, right? But they've got a long way to go to make a lot more investments, and Qualcomm will be the major infrastructure beneficiary there. T-Mobile is the most advanced in developing the Usernet market, the user market for that. And as I said, Dish is also building out, but Qualcomm is the leader in the infrastructure build out, and they're going to do very well. Airlines, I'm going to skip through.
Just on Qualcomm,
Yeah.
a major development today was the decision by the Federal Trade Commission to drop their antitrust suit. So this has been going on for 4 years, and a lower court decision in California determined that that Qualcomm did not act with anti-competitive practices, business practices, and the FTC made the final decision drop it.
California said that.
Yeah.
They're a bunch of weirdos too over there. I know, I grew up there. California's got some crazy ideas politically. And they decided.
Well, it was a federal.
It was a federal court in California, okay, because California can have some pretty, call it like futuristic legal opinions. Steel, big run up in steel, big run up. And let's finish off with Boeing. This is talk about Boeing. Just on time. We've got a couple of minutes here. Chris?
Thank you. Yes, Boeing reports earnings on the 29th of April, and there's been a lot of positive incremental news supporting the investment case here. The 737 MAX returned to service in December, and we've seen the order book grow for that particular model and some others, 787, which had some quality control issues which have been resolved. So importantly, 737 MAX is up in the sky again for commercial flights for a little over 3 months now, without any incident. One of the largest customers, which is Southwest, has increased their orders. Southwest exclusively uses that model. That's part of their strategy, and they think that it confers some advantages in terms of training for one particular model of aircraft. And they've also recalled a little over 200 pilots as they gear up for the summer in North America, and anticipated further recovery in commercial flight. So all of these little data points support the improved outlook for Boeing, whose stock is still about a quarter lower than the pre-COVID levels and 45% below the March 2019 high. So the quarterly earnings are going to be far less, the actual earnings figure is going to be far less important than the various elements that contribute to the improved commercial air flight travel outlook. So in summary, the 10 stocks comprising the relative value portfolio now being fully invested after having a portion of cash through most of last year. And we continue to recommend 2 of the backed stocks. We're very proud of the long-term performance track record, and open it up to any questions, please. We're right on time.
Yeah, there is. All right, thank you, Chris. A replay of today's presentation will be made available shortly after the presentation will be emailed to you. Listeners with additional questions can contact myself or the team via phone or email. Oh, there is a question. Thanks, Jordan. Thank you all for joining us. We appreciate your time. Stay safe, everybody, and you may now disconnect.
And we'll see you in the office next month,
Yes.
as long as Dan Andrews doesn't lock us down again.